Welcome to the Capital Playbook. It's exciting to bring to you another episode of this amazing show. And I know it's amazing because you guys are supporting this show. We have cumulative views approaching 35,000. So that's exciting. So allow me to thank you for supporting this show. And hopefully the content we bring you find valuable. Before we get into our show today and introduce our guest, I want to take care of a couple of housekeeping things. One, if you're watching this on YouTube, please be sure to like this episode or like our podcast, and also please be sure to subscribe and feel free to share this to all of your friends, because today you're going to be very interested in what we talk about. If you want to buy commercial real estate, we're going to talk about some of the inside secrets that you may or may not know. And we're going to do that with this young man here, a gentleman by the name of Mr. Mark Allen. Mark, thank you so much for being a part of our show.
Hey, Charles, thanks for having me. It's good to see you, as usual. From Dallas to Beverly Hills, it's always good to be in your company, bro.
Yeah, we've come across each other several times in different places. And I know one day we were, he mentioned Beverly Hills. It's easy to pick us out when we go places. We were at a pension fund event, or private equity event in Beverly Hills. So I walk in and I see somebody, and I was like, man, I know that guy. And he kind of comes over to me, and of course it's Mark Allen. And so it was good to see you at that event. And of course we've had an opportunity to do some business together, and it's worked out well. Mr. Allen is the director of the multifamily team.
That's
right?
correct. It's the AllenMultifamilyTeam.com. You guys check us out, and I would love for you to visit our website and see what we've been up to.
Absolutely, yeah. So I know he's very, very active in multifamily transactions. He's a commercial real estate broker, and so if you're looking for property, he is the guy to go to kind of guide you through the process. And that's what we're going to talk about today, is understanding the process for purchasing commercial real estate assets. So Mark, one of my first questions is, first let me ask you a little bit about your background. Tell me a little bit about your background, and then tell us how you got into commercial real estate.
Oh yeah, for sure, Charles. Dallas native, Dallas-Fort Worth native, and majored in real estate. My friend's father was in the housing, City of Dallas housing department and so forth. And they're like, hey, with your personality and so forth, how you're wired, you'd be great in real estate and so forth. And so majored in real estate. After graduating, worked for a bank. We were flying around the country buying up mortgages in bulk and then securitizing them. It was a subsidiary of Bear Stearns, and got out of school and worked with one of my frat brothers who was from California. Had a big line of credit that we used to buy some SFRs, and more fix and flip or fix and refi and hold. So it was a really good time. And then the market crashed, and so I heard something about a recession in undergrad, but it just went over my head.
Right, you missed that, huh?
Yeah, I missed that. And so then during the recession, went to grad school. Picked up an MS in real estate, met with developers and brokers all over the state. It was a really good program, and got out and worked for a small shop in Fort Worth, and busted my butt over there. And then phone starts to ring, and signed a deal with M&M over in Fort Worth, and did well there. And here I am now leading a team, and we've been having a lot of fun.
Oh, yeah, absolutely. Yeah. Well, a very interesting career. So, with everything you have seen over a decade, some ups and some downs and some recessions and some market adjustments, would you say that you've learned some lessons?
Oh, I've learned a great deal, many lessons. I used to have hair.
Okay.
I've learned some things, and that's why it's important that we're upfront in terms of what you need,
right?
To buy an asset or to get the most for your property when you're coming to market. And because there's a lot of different things that you're not going to find in the pages of a book,
right?
And a lot of nuances there.
Yeah, absolutely. So let's talk a little bit about the process of acquiring commercial real estate. Now, I'm just going to kind of paint a little scenario,
Okay.
and you help me to match that with reality.
Okay. All right.
Okay, because I think there are a lot of misconceptions about what it takes to purchase commercial real estate. So here's the scene or the scenario. You have listed a commercial real estate property for sale, a multifamily property, 120 units. It's $14 million. I just happen to have, about $4 or $5 million. I have a relationship with my banker. I know I can get the financing. Call you up, say, hey, Mark, I want to buy this property. And so in my mind, I just show up, sign the contract, and about 30 days later, we close on that deal.
Yeah.
Is that how that happens?
No, it doesn't happen that way. The thing is, you're competing with so many different people from all over the country, and so some guys are going to have a track record, and they may have done this time after time, and so at some point, most of the buyers have capital. Most of the buyers, look good. They've been pre-qualified with their bank, which is, something you definitely need to do before you call me. And so because of that, then we start to narrow it down. Well, okay, this guy over here, we're looking at that offer. There may be things in your offer that aren't strong as they are in this other guy's offer. Maybe you've done more deals, but you're not offering non-refundable earnest money. And this other guy over here, he's like, look, I'll give you $200,000 non-refundable earnest money. I don't care what you find at this property. That earnest money is now at risk. And so that type of experience puts that person at the front of the line because that's given the seller a surety of close.
So there is a thing in your world called a qualified buyer.
Correct.
Okay, and so there are certain things that a person would want to do to be perceived as a qualified buyer.
Correct.
Right? So what would you say are some of those things that would make a person more qualified than perhaps others or their competition?
Yeah, I think that, we get a lot of phone calls every day. And so what stands out to me is, one, what is this person's background? Have they, done this before? And so a lot of times, we're in the information age. And so it's easy to get information and call up any broker and say, hey, I'm interested in XYZ. But, is this person already pre-qualified with their mortgage company where they already know what kind of range that they can bear should they elect to buy a property? Two, again, the experience is helpful. Three, do they have a reputation in the marketplace for executing and closing deals, or do they have a partner that's going to be with them that's more seasoned? Because if you don't have a track record at all, we don't know how you would be once we're under contract.
Right.
And so it's a risk for us where maybe it's taken us 2 years to get this listing agreement, and the seller is given a vote of confidence in hiring us. And so we want to make sure that the person that we are doing business with can handle everything that comes with the stress of taking that property under contract, doing their homework in the due diligence phase, and having the ability to get funded. And if there is a little hurdle in there, that they're not going to get squeamish and have spaghetti legs and not execute. Because in theory, hey, I want to buy this property and this is going to be great. But the reality is there's different little things in every deal that maybe I'm not aware of even. And so I think that experience does speak for itself. Being pre-qualified helps. And then somewhere you have to display that you're committed to that deal. In the world of multifamily, it is, in my opinion, the most coveted product type in commercial real estate, because at the end of the day, and from a retail standpoint, if the market goes bad, instead of going to grab that food to go from a restaurant, you may opt to cook at home.
Right.
In terms of office with technology, hey, maybe if we get some other weird, COVID situation, hey, you can work from home, but you got to have home.
Somewhere to live.
Yeah,
right?
so to protect you from the elements and the weather and all
Right.
this. So that's not changing anytime soon. I don't think there's going to be an app that's going to create some little bubble that can
Right.
give you a roof over your head. So because of that, we have so much demand. There are 1031 exchanges, and they're coming from all over the place, all over the country. And because of the demand, buyers are proving themselves more and more to be selected and to get, picked to even get the deal under contract.
Right.
And so it's important to put your bio in there. Who are you? You
Right.
know, and some guys, maybe they don't have the strongest record in the multifamily arena. It could be in a different product type or whatever. And then, so some guys, what they'll do, they will team up with someone that does have that track record, even if that person has a slither of equity in the deal, that still helps them a great deal.
Okay, man, that's a lot of information. So a person, in order to be successful in winning this opportunity to purchase this asset, they want to be, I'm just recapping what you said, they want to be qualified.
Correct.
And qualified means they need to demonstrate that they have the capital to close. They need to have a good reputation in the market for closing.
Correct.
They have to demonstrate they have the experience for managing that type of asset. And they have to, and sometimes they may have to bring partners in that have a strong balance sheet or a strong reputation to kind of help them.
Correct.
Is that correct?
That's correct.
Yeah. So now you mentioned that a part of this competitive set of folks that are buying commercial real estate, that would include 1031 exchange buyers.
Correct.
Okay. Now, for our audience, and some of the folks in our audience are very experienced commercial real estate people. Some are just starting to get into commercial real estate. Could you explain what a 1031 exchange buyer is?
Yeah, so a 1031 exchange buyer is a group that maybe they just sold an asset. Let's say hypothetically they sold a property for $10 million. So now to avoid capital gains tax, the government will allow them to buy a property that is north of 10 million. So if they can immediately do that within a relatively short period of time, they can avoid those capital gains that normally they would have if they immediately are buying another asset. So those are very bullish buyers typically because they've got a time limit, and they also have a certain amount of capital at risk.
Right.
And so even though they can come to the table and make an offer, we still have syndication groups where there's teams of people that come together and gather up capital to pay the down payment as well as some improvements. And so even though that exchange buyer's at the table, now you've got a syndication group at the table, and then you may have a private client that doesn't have a 1031, that doesn't have a bunch of partners. And so if they're all offering, let's say hypothetically, $15 million for the same asset, that seller has a decision to make. And so we would do a best and final round to see, okay, we got these top three groups. Which one of you are going to step up to the plate? And so we may have a situation to where this exchange buyer, maybe he has a reputation of being a headache.
Right.
And so, or a guy that wants to retrade you. And then we have a syndication group. Well, they may not have the ability to put so much money at risk because they're using other people's money. Then we have this private guy over here. Maybe he or she is, well qualified, good reputation, and doesn't have to take a vote on what they want to do on that offer. So they could come in and say, okay, here's $200,000 non-refundable day one. And you know what? I'm going to release $50,000 to $100,000 to the seller the moment that they sign that contract.
Wow.
So that blows out the 1031. That blows out the syndication.
Right.
And, little one-man army over here takes the deal down.
Right.
And so we see this happening all the time. And so all three, in this particular scenario, all three have experience. All three are offering the same dollar amount. And so, or sometimes it could come down to, hey, same earnest money at risk, same price. Oh, but this group says we'll finish our due diligence in 20 days. This other group is at 30. This other group over here is at 40. So you end up saying, okay, well, let's go with this guy because they're only going to be tying us up for 20 days in that due diligence period. Right. So it's all these little things. And then I would say relationships are key in our business, as you know, Charles, and that goes a long way because sometimes as a broker we see a lot of different opportunities in the market, and if we know that you can execute, then we'd rather save time and headache and just say, make one call and say, hey, I got this deal, great, and that deal is done. It never seen the light of day.
And that's so important. I tell people all the time, just in business in general, your reputation. Okay, you might win, and there are a lot of people that are learning hard lessons. Because they might have won a deal, or whatever, right? But it might be the last good deal they see. Right. Has that happened to you where you're like, okay, you will win this deal?
Oh yes.
But this will be the last one you see.
Oh yeah, for sure. There was a property, and I'll try to keep this very, very short. There was a property in Fort Worth. I think it was around 62 units, and it was a gentleman from the East Coast. We got under contract, and every step of the way he continued to try to retrade the seller and things like this when it was a highly, highly coveted deal. Right. Whereas if I known that going in, I would have
never picked him.
Correct. Yeah. And so that was the last transaction that I presented to that gentleman. Not that he doesn't receive our information, but I'm not going to do that to my seller. Right. Because you just don't want to do that. You want to put your sellers in the best position. Right. And, and then on the financing side, we've had guys that, maybe they come to the table and they are telling us one thing, but then behind the curtain, there's something else going on. And so we've seen situations where, people really have a tough time. And so I think having that done on the front end and the ability, so if someone comes to me from you and they want to do a deal, well, I have a relationship with you. I can call you and say, hey, Charles, so-and-so called me, and boom, you can speak for them. Right. And so that goes a long way. Yeah. So what would you say has been the most creative thing a buyer has done to make sure they win the deal in your experience? Some of the most creative, definitely using that earnest money as leverage. One deal we did, it was a 2-property portfolio, and I think it was about 300 doors combined. And so the group, they put up and released $300,000 to the seller day one of execution. So you're gonna win that deal, right? Because even if you walk away, we made $300,000, right? And it's in their account, right? So they're good. Right. And other scenarios where they leave the seller, they'll do some really a good price, good earnest money, and then they'll say, well, you know what, Mr. Seller, we're going to give you some equity in this deal going forward. Here's 5% or whatever it is. So we're going to stay in with us, and we're going to take care of you on the front end. So that is really good to do at times. Okay, absolutely, man. That's so. Now let's talk about the steps. So we win this deal. We get it under contract. Okay, and maybe we got creative. We release money and all that. Now, do we just sit back and wait to close, or what? What are some of the steps? The next step for that buyer would be what? Once it gets it under contract. Okay, so you're under contract. Now it's time to do your due diligence. And on a larger multifamily transaction, we're doing one right now. It's 180 doors. So groups, you can do that due diligence yourself, or you can hire a third party to come in, inspect those units for you, and things of that nature, which I advise that's what you do because they're going to pick up things that maybe you won't. And so it's good to have a third-party property management come in and do that inspection for you. And I'm speaking in terms of multifamily where you got over 100 units and, different tenants are doing different things in those units. And so once that's done, you're reviewing all the leases, you're reviewing every contract that's associated with that property, whether it be electric, whether it be garbage, landscaping, and so forth. And so you're making sure everything checks out. And maybe you find something that is wrong with the property physically or financially. If it's then you may need to renegotiate the price with the seller at that point to see, hey, we found this issue. It's a $100,000 problem. Would you go ahead and reduce our price by this $100,000? The seller may opt to fix that problem. He may tell you to beat it. I'm not doing anything, and this is the price. Take it or leave it. Or he may decide, hey, I'll split the difference with you. Or he may opt to reduce the price. And so you have to work through that, and you have a short period of time to do that, and you have a lot at risk. And so you have to be highly concentrated in that. And I think also during that time, you got to work with your lender because we're dealing with people. Right. And so maybe that all this information is being relayed to the underwriter at the bank, and you have to have those conversations to explain what the seller has been doing and also display what you plan to do in the future so that bank is comfortable with you. And I'm sure you see that.
Oh, yeah, absolutely, yeah. And we'll talk about the financing side because we really want to dig into that, because obviously the deal is not going to transact unless that money comes into the
That's
deal.
right, yeah.
Right, so that's very important. But now we get through due diligence, and we'll dig into the whole plethora of things you need to know about the financing side when you're going into this transaction. But assuming you have that lined up, and that's good, you completed due diligence. What's the next step?
Well, now that you're out of due diligence, it's coming to that assessment. Does this deal work for you at that price? Have you got enough bids if there's something physically going on there? And do you have a good budget and plan in place so you can hit your future strike on this deal?
Okay.
And really taking time to assess that. And once you get there, now you're going back to that seller to say, hey, we've reviewed everything. We know we were under contract. Let's say, for simplicity's sake, we were under contract with you for $5 million. After our review, we feel that we need to be at 4.7, and here's why. And you list that and you convey that to that seller. And again, now this can be a thin line depending on what is found and what those perceptions are. Because in a market like Dallas, it is a seller's market. Right. And so the sellers have a lot of sway, but there are a lot of reasonable people out here that will work with you. But that's not every case.
Right.
So
Okay.
so you're kind of negotiating that out. Once that is done, now after that, everything is about financing at this point. Okay. And that's where all your energy and time is going to go, because now, again, you're under the gun to get the wire from that bank to send to the title company and
close that transaction. Yeah. Now, let's talk about that, because it is so important. And there are so many misconceptions about financing. And you hear us talk about, when a lot of buyers, especially inexperienced buyers, they want to finance a transaction, they will heavily depend on their bank in some cases. You probably have seen that, right?
Correct.
Have you ever seen the bank let them down?
Yes, I've seen that. And the unfortunate part about that, you've done all this work. You've hired a third party for your due diligence. You've hired, in some cases, you've had to pay for an environmental. You've released earnest money and so forth. And so this is critical. And if you've only got, it's like these chairs. There's multiple legs to make this, to give us this stability. Same with a table. It's 4 legs. So the more options that you can have for your debt, the better. Because things do happen. Rules change within the middle of a transaction. We had COVID, and so we had various deals that were under contract, and right in the middle of that, the lenders were like, well, great, we know we approved you here, but we need a year worth of debt service from you and it's up front, and it's going to sit in our account for 6 months to a year with us,
right? Or we need you to have a reserve account now,
correct? Right,
which takes away from your cash flow, which means we're going to keep all of your earnings,
right?
So we've seen that. So that client, you got a client A who's advising himself on his capital.
Okay.
And you got client B who hires a capital advisory group.
Right.
And that group has multiple sources of capital, multiple resources. Who's going to fare better in the long run, you think?
Clearly having the options, right?
Right.
I mean, I've seen transactions where a lot of guys like Fannie and Freddie insured deals. And that's good. But in every case, sometimes it's a timing issue where you don't have enough time for them to do what they need to do. And so then there's regular, good banking relationships that'll pretty much give you everything else and can close it faster. But if you're not aware of that, now you're under the gun, and so you're either going to have to come out of pocket more, release more earnest money, tie up more time, have things at risk. Now you've got a frustrated seller, and so there's a thin line there that's making that deal more and more difficult. So if you have, again, 5 different options. Hey, this is conventional. Oh, this is agency debt. Oh, this is a pension fund. Oh, well, I've got a private guy hanging out here because maybe you had a syndication and out of nowhere you were banking on this $500,000 to pay towards your close to your down payment, and the guy walks.
Right.
Well, now what? You've got this at risk, and where are you going to get someone else to fill that gap?
Yeah. So the right advisor is going to make sure that you have a plan A, plan B, C, and D, and that advisor is working with everyone involved. He's working with the broker. He's working with the buyer. He's understanding the seller. He's also part of that due diligence,
right?
Because he knows what can be financed and what can't.
Right.
Now let's talk about another important role that an advisor plays with regards to the strategy of that asset. There's an acquisition strategy, and you talked about that. I'm going to acquire it, and I'm going to do these things.
Correct.
Some of these may be required to just keep people in the building, right?
Right.
I might come in and hire an exterminator to kill a road. That's part of your acquisition strategy.
Right.
There's a repositioning strategy.
Yes.
Right? Which means I'm going to come in, I'm going to look for a way to extract more value.
Correct.
Out of this asset.
Correct.
There's something you're going to do to make this more profitable.
Right. Some groups, hey, you're buying the deal, the landlord's been paying for water.
Right.
New guy comes in and say, hey, going forward, tenant, we're going to...
Can't have no water.
Yeah.
No joking. You got to pay for your own water.
You got to pay for your own.
Right.
And so immediately seeing that difference there.
Okay, so that's a repositioning strategy.
Correct.
And then what's most important, and a lot of people don't match this up when they're considering how they're going to finance the deal, is their disposition strategy.
Yes.
So now let me ask you, in your experience, have you seen this?
Okay.
Guy comes into a transaction, he wins the deal, he has his acquisition strategy, has his repositioning strategy, and maybe has a disposition strategy. Maybe he's going to come in, create value, sell it in 2 years, but he goes and gets a 10-year loan with defeasance.
Oh, yeah.
You ever seen that happen?
I've seen it time and time again.
Tell our audience what is the problem. They've taken this strategy.
Okay.
That's a great strategy, right?
Yes, right.
But they put the wrong financing with their strategy.
Yeah.
Tell me what kind of problems you've seen because of that.
Well, it's tough sometimes because the market fluctuates. And so interest rates, what is a good interest rate today may not be a good interest rate tomorrow.
Right.
And so if you look at, prior to COVID, everyone was excited to have a 4.5%, in some cases 5% interest rate. It was great. It was low and so forth, and everyone's all excited. And so no one's anticipating COVID, and so bam, we run into it. And so you've got someone had this plan 3 years ago, now they want to sell, and when they got that loan with defeasance on it, it was great. It was got this great interest rate because that's what they were buying, right? They were buying that interest rate.
Right.
But now, number one, that interest rate isn't favored anymore.
Right.
They want it lower, right? They want it at 4 or even 3% and some change. You've got this terrible defeasance, nasty yield maintenance and or prepayment penalty associated with this debt, which throws off what you wanted to put in your pocket. I've heard stories as of late where guys are saying, well, hey, we got this great offer on our property. We're going to take it. Oh, but we've got to pay $5 million to defeasance and or yield maintenance penalty for getting rid of the loan this early. And so in some cases it's better to do a Freddie floater and things like that, where you don't have that yield maintenance, or even take a little bit of risk and do it conventionally so you can get out easier.
Or just make sure you match up your strategy with, if you know that you're going into a transaction and you're going to hold it for 2 years, don't lock it up on a 10-year loan with defeasance or yield maintenance, because that interest rate, which does not reflect the total cost of capital, it's only a portion. Okay, because if you got to pay $5 million to get out of it, guess what happens to your cost of capital? So that interest rate doesn't look as attractive anymore.
Not at all.
Right, and so sometimes if you're matching the right financing up with your strategy, you have to first know what you have to have. Know that you have a strategy.
Right.
So you ever see people go into a transaction and not really have a strategy?
Yes, all the time. And so we're here to advise them what they can do, how they can make their property better, small things that they can do to prepare to exit, and where they can go after that. We may have to help them with a 1031 exchange, and so that cycle starts all over again.
Absolutely.
Where are they going to get debt from? What kind of deal are they really looking for? What do you really want versus what do you really, really need?
Right.
Because, time is of the essence on these deals. Yeah.
And, like you, I've seen some terrible stories with folks. They never imagined that cap rates, which is a metric we use to indicate the value of an asset, okay? They never imagined cap rates to be as low as they are now, especially in Dallas-Fort Worth. So that means if they bought a property 5 years ago, okay, and perhaps you've seen this.
Oh, yeah.
And they're chasing interest rate. I got to have the lowest rate. I don't care about what it takes to get out of this loan. I have to have the absolute lowest rate, right?
Right.
And they get locked up in a 10-year deal with defeasance or yield maintenance.
Yeah.
And now 5 years later, market changes, high demand for housing, and then you got foreign buyers.
Right.
You mentioned the syndicating groups, which are just popping up everywhere.
Right.
You got 1031 exchange folks because they're selling their stuff, making huge profits.
Right.
Okay, so they have all this money that they have to place somewhere.
Right.
That one guy that just retired with the $400,000, he don't really have a chance. He doesn't have a chance. You have all this competition, and so now I can sell that property for millions of dollars in profit.
Yeah.
But I got to give it all away to the lender.
Yeah, your lender's going to be sitting there with a smile because they're going to get a huge prepayment penalty. And we kept seeing this. So guys didn't want to assume those loans either because they're looking at the rate like, oh, well, that's a 4.5%. That's too high.
Right.
And
then there's still also a fee associated with assuming the loan.
Yeah, there's a fee to assume the loan. And then there's, in some cases, additional capital that's needed.
Right.
So it could, because of that yield maintenance, now you're putting the buyer in a position to where they may have to put 30% down, where they're on, and I'm speaking multifamily guys, which typically is 20 to 25% down. And so they may have to put up 33% down to try to avoid that yield maintenance. And guys are, considering taking a lower price in a lot of cases. I can't say the names, but I have a client that was like, well, hey, if you assume this, I'll give you $500,000 off the price. You know what? Matter of fact, how about $750,000 if you assume it? How about $1 million if you assume, because that yield is that
so
bad.
high, yeah. And so with the right advisor, a good capital advisor, they're going to explain what the consequences are with that loan product.
Correct.
And here are all the products that are available. And if your only metric is interest rate, then you might be headed for trouble.
Right. There's only one. And I think the funny thing about that is, like, I've seen situations where guys are saying, oh, well, I'm going to walk away from this deal over a rate, forgetting all the upside on the opportunity.
Right.
So you're going to walk away from this deal because it's half a point higher than what's available today and not receive a good ROI.
Right.
So that's a weird deal.
Yeah.
So you can't just look at rate all the time.
Right.
That's just only one issue.
Yeah, you have to look at your overall business strategy, your overall cost of capital, and then those other metrics we talked about: internal rate of return. We talked return on investment, cash on cash returns, and if you're getting involved with commercial real estate and you don't understand the key metrics or the measures of the business, then that should be a starting point. Would you agree?
I agree with that.
Yeah, it's kind of like learning how to play basketball, but never learning how to keep score.
Right.
You won't know if you're winning or losing.
No.
Because you don't know how to keep score. I score a point every time it goes in. Oh, okay. If you don't know that, you might lose. When you really won.
Yeah.
Or you might win when you hardly ever win when you don't know how to keep score. So understand the metrics of the industry. And once you understand those metrics, then you can figure out, number one, you're going to find out that interest rate plays a small role. Okay. What's more important is your strategy, your entry strategy, your repositioning strategy, your disposition strategy, and then bring in the right type of capital, whether equity or debt, that complements the strategy.
Right, because some equity is terrible.
Oh, yeah.
Guys will participate on the deal with you, but then how much are they going to charge you? How much control are you giving up for that equity? I've been in the business a while, and so I've met guys that, are quote unquote owning, let's say 16,000 units all over the country. You see them at NMHC going down the hallways. They've got tons of people surrounding them,
and they're doing all the work.
And they're doing, and so from
somebody
the outside,
else getting all the money.
Yeah, and from the outside it looks great.
Right.
There's a smile.
Yeah.
So and so, 10,000 units. But what that picture and so forth isn't saying is that no, I got capital call after capital call all day, every day. Some guy in his living room, calling saying, well, why did you paint it this color? And why didn't you charge extra $25 on unit 202 from their house, when the guy that is sponsoring the deal is working his tail off because maybe he was so excited to get in a deal and he brought the wrong private equity into that deal. And so you want to be careful with all of that. And I think in this the climate that we're in today, where everyone is excited about the business as a whole, there's still some fundamentals that you kind of gotta watch, and myself included, as I look at the marketplace and who I'm kind of going down that road with, right? Because you hear different stories where, we brought so and so, he's bringing 700,000 to the team or whatever the case, but that same guy is calling you every
trust
day.
Me. I've been through that experience, and we take them off our equity list.
Yeah. Well, I noticed that there was a napkin on the sidewalk. Charles, what's going on with that napkin? I was driving by, I flew in, and whatever the case is,
and it's important, and that's where that advisor. If you don't have an advisor, this is an asset that can make or break you.
Yeah.
Okay, and there are people, they win the deal, they get the property. That's just the beginning of the story. If you don't have the right financial partners, equity or debt, on that transaction, it could really, or someone advising you to understand the type of equity you want to bring in. Is it preferred passive investors, or is it a JV investor?
Yeah.
That JV means joint venture. That means that's a measure of control.
Yes, and I've got guys, we've got this opportunity, and I'm like, okay, well, great. What does this person want? Because it's their land or property. Well, they want X amount of control. Well, you have this land, hypothetically, but it's only worth a certain amount, and so there's so many other factors that come with that. So then. How much control do you really want?
Right.
And so you have to, find out what that is and measure that. So to have those advisors that can really look at the value of that and explain it to everyone, so we're all on the same page with what's going to happen going forward.
Yeah.
So without that, it's it can get kind of interesting.
Yeah, I tell you what, we've seen stories. We've seen great success stories.
Yeah.
We've seen people enter in this space and exit very quickly.
Yeah.
Usually in tears.
Yeah.
And we've seen people that have had, we've seen people that have long careers in this, but the ones that really make it are the ones that will stop and listen, get the right advisors, and not just on the finance side, but legal, insurance, making sure working with the right title companies, right broker, knowledgeable broker in the space, someone that has experience. And these people that really make it are the ones that are interviewing these people to determine if they're the right, broker or the right insurance agent or banker or advisor, right? But people that just say, you know what, I'm just going to handle this and I got it, and in what area of life do you just do that?
Right, and it is such a relationship business too. And what I've seen is some investors there working together with the same few commercial real estate brokers. They're working with the same few lenders, and because they know each other, they know that temperature, how that person operates, and so you get it turnkey, and you're doing a number of transactions over and over and over. So it takes teamwork to make the dream work.
There you go. It takes a team. So top 5. Now it's time for our top 5. So if you were going to present the top 5 things a person needs to know when acquiring commercial real estate, particularly multifamily, what recommendations would you make?
Again, I would, number one, go get pre-qualified for where it is that you stand, right? We all have to take self-assessments, across the board in life. And so definitely when you're taking down a multifamily transaction, you want to know, where do I stand? How much of a property can I buy?
Okay.
I can't tell you the number of phone calls I get, and they're like, hey, I'm looking for, Class C deal in a, great area of value add. Okay, awesome. What price range were you thinking? And it's crickets, because they haven't even looked at that. So I would think that is number one. Number two, to your point earlier, well, what is the purpose? What do you want? So why are you doing this? Is that you're doing this because it's trendy, or are you doing this because you're looking to make a certain amount of return? And so, some people will call and say, hey, look, I'm looking for deals, from 0 to 1975. Some groups, they're, hey, we're going to look at deals with a certain household income, and 1980s to 1990s. That's what we want. And so anything outside of that box can be kind of a waste of time if it's not within those guidelines and criteria that you create going into this, because you're doing this for a return to get in and get out. Right?
Yeah.
And so knowing exactly what you want, and then after you look at what you want and you hit the real world where the rubber meets the road, is what do you really need?
Right.
And so, because it may, you may have 5 things that you really want, but what you can really get is 4.25 based on all these other factors, the competition, what properties have been presented to you at that particular time. And once you can settle on that, then you can strike a little faster, because it is not a perfect world, right? So what do you really, really need at the end of the day?
Right.
And sometimes that could be, well, we ended up being in a different area than what we thought, but we're getting what we really need. Maybe it's even a different vintage than you thought initially, but you're getting the yield that you need, because we know that if you just have a capital just sitting there, it's not going to go to work for you. So, and definitely having good advisors for sure, that can help you not only find a transaction, a good real estate broker that can help you find a transaction or sell your transaction that's going to protect your interest, right? Protect your neck. A good advisor on the finance side that's going to protect your interest and have multiple options for you. Those things are very, very vital. And then depending on the complexity of the asset, even if it's not a lot, it's always good to have an attorney hanging around that can review a contract for you, that can review different terms that maybe you're not familiar with. It's just a good little layer of protection there. And there are some really good attorneys out here that aren't ridiculously expensive, where you can turn in, even if it's some language for title in some cases, or a little bit of language of a section of your contract. You don't always have to have them review everything. It just may be one key component. So insurance guys, and usually good people know good people, and so it turns into a circle, if you will. And so there's a reason why they're doing so many transactions year after year, because they've got all the tools that they need. And so
Okay, well, good deal. So number one thing is just make sure you're prepared. You have the right advisors, you have the right protection in place. Make sure your capital is right. Understand what you need. And versus what you want.
Right.
Okay, and so that puts the person in the best position to be successful. Just because a person has money doesn't necessarily mean they're going to be successful in multifamily, or they go out and create this huge syndication group.
Right.
and convince unwary people to give them their money.
Right.
That doesn't necessarily mean that project's going to be successful.
No.
If they don't have a plan.
Right, and I think that is huge. And again, what type of investor is that?
Right.
Although they may have a few $100,000 or whatever it is to invest in that project with you, have they also done this enough to where they're not going to? You've basically put yourself in a position to where you have this stressful job,
no doubt,
with all of these people. There was one gentleman, he had, I want to say, about 400 investors, and he really moved quickly. He was able to put a great portfolio here in DFW together, and they had some success. But the investors that he brought in, some of them were newer, and he could not escape his phone, and it could be for anything. Well, hey, I noticed that there were some cars over there yesterday parked in this on the parking lot there, and it's like, dude.
Yeah, he hired 400 bosses.
Yes.
And again, you got to have someone advising you who has experience if you want the best chance of being successful. So it's great, Mark, that you've taken the time to help us see behind the curtain. Because it looks glamorous to say, man, I own this multifamily, I own this, and da-da-da. But, boy, there's a lot of stuff that goes into that.
Yeah.
So thank you so much for being with us, and I'm sure our audience appreciates it. Mr. Mark Allen, the man.
Hey.
The Allen Multifamily Team. Go to his website. What is that again?
It's AllenMultifamilyTeam.com. Thanks, Charles, for having us here. I've seen Pioneer Realty over the years, and it's good to be here with you and also get some projects off the ground.
Absolutely, yeah. We got some exciting things that we're working on together. So, again, folks, thank you so much for being a part of our show. Don't forget to like and subscribe if you like this content. We're going to be bringing other folks to educate you about the commercial real estate industry. We have folks that are experts in insurance, experts in legal. We're going to bring on multiple capital groups to really help you understand how the capital markets work. This is your opportunity for some free training, so take advantage of it. Like us, subscribe, and continue to support our show. With that being said, thank you so much for being with us, and we look forward to seeing you on our next episode.